Passive income allows investors to earn money without constant involvement, which is particularly important for those striving for financial freedom. To organize a life on passive income, tools are needed that not only preserve capital and provide returns at the level of inflation, but also bring real profits. Now I will review some of these tools. Let's start with the definition. Financial independence is a state in which your capital generates sufficient cash flow to cover all your needs and wants without the need to actively work. This is a goal many strive for, and it requires careful planning and thoughtful investments. To achieve financial independence, it's important to choose the right investment tools. You need to consider not only potential returns, but also risk, liquidity, and taxation. It is crucial to create a diversified portfolio that can withstand market fluctuations and economic shocks. Let's start with the classic stocks. If we're talking about living a calm life on capital, I recommend focusing the portfolio on dividend stocks, either by buying them directly or through ETFs and mutual funds that hold dividend-paying securities. This allows you to receive regular payments and live off them without selling the securities themselves. Dividend stocks offer significant advantages. First, they have the potential for capital growth, as stock prices can increase over time. Second, they provide a steady income through regular dividend payments. For example, companies in the S&P 500 index regularly pay dividends with an average yield of 2 to 3% per year. However, investments in dividend stocks have their drawbacks. The stock market is subject to fluctuations, and stock prices can change significantly depending on market conditions, which poses a risk for investors. Additionally, successful investments in dividend stocks require careful analysis of companies to select those with sustainable dividend payouts and a strong financial position. After acquiring stocks, let's look at choosing dividend ETFs. Why ETFs? Dividend ETFs pay investors a stable income each month. These funds are often positioned as retirement funds, creating a sense of stability and reliability. However, this is mostly for psychological comfort and does not improve the characteristics of the portfolio. To ensure a pension, it's important that assets generate sufficient income, regardless of whether it comes from stock growth or dividends. For example, Vanguard's retirement ETF does not select securities that guarantee a certain dividend yield. It manages assets so that it always sends the same amount to investors, including selling some securities. Nothing prevents you from doing the same independently if your portfolio grows quickly enough. While dividend ETFs can offer stable income and a certain psychological peace of mind, it's important to remember that the main goal of investing is overall capital growth. Income from dividends is only one component of returns, and it should be evaluated in the context of the overall portfolio performance. Investors should remember that dividends can be reduced or cancelled in case of financial difficulties of the company. Therefore, diversification and careful selection of funds remain key strategies for minimizing risks and ensuring long-term financial stability. Diversification is the key to successful investing. By investing in a wide range of assets, you reduce risk and increase return potential. ETFs and index funds offer an excellent way to diversify, providing access to various sectors and regions. Stocks or bonds? Some compare the dividend yield of stocks to the coupon yield of bonds and don't understand why to invest in risky assets. However, stocks generally generate returns even without considering dividends, outpacing the rate of inflation. The coupon yield of bonds, on the other hand, does not show full returns, as it does not account for inflation. Historically, stocks have shown higher returns compared to bonds over long time horizons. Despite greater volatility, stocks can significantly increase your capital through price growth and reinvestment of earnings. However, it's important to consider your time horizon and risk tolerance. To assess the real return of conditionally risk-free instruments, it's better to focus on bonds whose principal is indexed to the level of inflation, such as TIPS. Historically, government bonds worldwide have yielded about 2% per year above inflation. Types of bonds. There are many types of bonds, including government, corporate, and municipal. Government bonds are generally considered the safest, while corporate bonds may offer higher yields due to increased risk. Municipal bonds often offer tax advantages, making them attractive for investors in high tax brackets. If you want to diversify your investments and not depend on the situation in one country, you can consider decentralized finance, DeFi. In this world, there are projects offering various financial services based on decentralization. For example, you can place your cryptocurrencies on special platforms and earn interest from their use by other network participants. Decentralized finance offers unique opportunities for earning income. Returns on DeFi platforms can be significantly higher compared to traditional financial instruments. Additionally, DeFi offers greater flexibility and access to global markets, which can be attractive to experienced investors. However, it's important to remember that investments in cryptocurrencies carry increased risk. You can lose money due to inattention, hacking, viruses, or stablecoins losing their peg to the dollar. But if you understand the mechanisms of DeFi, risks can be significantly reduced. This allows you to earn nominally from 4% to 10% per year in dollars, which is between the returns of stocks and bonds. The real cash flow here can be around 5 to 7% per year. Risk management is a key aspect of successful DeFi investments. This includes using reliable platforms, diversifying assets, and constantly monitoring your investments. It's also important to stay informed about the latest news and regulatory changes to minimize potential losses. Next, let's consider real estate as an investment tool. Real estate has always been considered a reliable investment asset. However, passive income from real estate requires significant investment and active management. With the right approach, real estate investments can provide stable and significant income. The average yield from renting out housing in the US varies depending on the region. In major cities like New York or Los Angeles, yields can range from 3 to 5% per year. In less saturated markets, this figure can be higher. Over the past 7 years, home price growth in the US has averaged about 6% per year. Real estate investments offer many advantages, including potential value appreciation, stable rental income, and tax benefits. Additionally, real estate is often seen as a hedge against inflation, as property prices and rental rates tend to rise with inflation. However, real estate investments have their downsides. They require significant initial investments, can be less liquid compared to stocks and bonds, and require substantial management and maintenance costs. Additionally, market fluctuations and economic conditions can significantly impact the value and return of your real estate. Alternative investments. There are many alternative investment opportunities that can provide significant returns. These can include hedge funds, private equity, venture investments, art, and collectibles. Each of these categories has its unique risks and return potential. Venture investments offer the opportunity to invest in startups and growing companies. While such investments can be high risk, they can also bring extremely high returns. Investors should carefully evaluate the business models, management teams, and market opportunities of the companies they invest in. Art and collectibles can provide significant returns and diversification. These assets often do not correlate with traditional financial markets, making them attractive for investors looking for ways to protect their portfolios from market fluctuations. However, investments in art and collectibles require significant knowledge and experience for evaluation and management. If you are just starting to dive into the world of investments, the real cash flow you can expect is between 3 and 7% per year, depending on the level of risk. Consider the real returns of financial instruments adjusted for inflation, not the appealing payout amounts. If you receive payouts totaling 10% per year, a large portion may go towards covering inflation, making it no better than earning 3% per year with capital growth. If you want to build your initial capital but feel you lack financial literacy and knowledge of investment strategies, I invite you to subscribe to my channel and write the word investments in the comments. I will send you a detailed investment guide and an effective strategy with 3 ways to invest your money to generate lifelong passive income. Money will really start accumulating in your accounts, and you'll see an increase. Try it out. Write investments in the comments, learn, and grow wealthy.